Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
Hey, when you're looking at retirement, there's a lot of risks that you have to consider. Longevity, how long you're going to live. Inflation, looking at the cost of goods and service increasing. You have to take a look at interest rate risk. As interest rates go up, bond prices go down. You have to take a look at stock market risks. Stock markets are at all-time highs. How do you put all this stuff together? But here's something that's missing. There's a big risk that a lot of you are not necessarily looking at, and it's taxes. It's taxes. That's what we're going to get into today. Welcome to the program. Show's called Your Money, Your Wealth. My name is Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. I'm with my partner, the big man, Big Al Clopine. He's sitting right over there. We have a phenomenal show lined up for you today. Over the next half an hour, we're going to look at some strategies to put a lot more money into your pocket. We want to look at things that you can control. You can't control interest rates. You can't control the stock market. But you can control the amount of money that you pay in tax if you do the right planning. That's what's on my mind today. All right, taxes. Let's talk about it. Where do you think tax rates are going to go? Do you think they're going to go up or do you think they're going to go down? I believe they're going to go up. And if you take a look at the landscape of retirement, in retirement plans today, a lot of you are going to pay a lot more tax than you ever thought you would. Because taxes, in our opinion, for most of you, will be the biggest expense in your retirement. Let's take a closer look. So when you look at your overall retirement accounts, there's different ways that you can invest. Most of your money is sitting in this little quadrant right here. That is your IRAs, your 401ks, 403bs, TSPs, you name it, your retirement accounts. There is $24 trillion sitting in these accounts today. $24 trillion. The IRS is salivating. They're waiting for you to either make a mistake, reach a certain age, or die. They love it when you die with a lot of money here because it's a huge tax. There's things that you can do to diffuse this tax time bomb because every dollar that comes out of here, out of your IRAs and 401ks, is taxed exactly like your paycheck. Most people don't realize that. If you want to maintain your same lifestyle in retirement, and if all of your income is coming from your retirement accounts, how are you going to be in a lower tax bracket? You'll probably be in the same. Some of you might even bump up to a higher tax bracket. To help me out, let's bring in the CPA, the big man, Big Al Clopine. Taxes, buddy. You know, you've been a CPA for what, 30 some odd years. And I think still, when it comes to retirement planning, there's a lot of things that people can do, but they just don't realize it.
Well, there are, Joe, and I got to say, so this is my most favorite time of the year because it's tax season is coming and winding down to a close. And a lot of you are getting your tax returns and realizing, wait a minute, I'm paying more taxes than I really want to pay or should pay. And when it comes to retirement, really, there's a lot of things that you can do. And we're going to get into one of the best gifts the IRS has given us in years. And what it is, it's called the Roth IRA, the amazing Roth IRA. What this is, it's a different kind of retirement account that was created in 1997, different than most retirement accounts in that you do not get a tax deduction when you put money in, but it grows tax-free. So all principal income and growth is tax-free. So we're going to talk about what is a Roth IRA and how to get money into the Roth. You can do Roth contributions. You can do Roth conversions. I know that sounds like the same thing, but they're completely different. One of them, the conversion, you can put a lot more in. And then some of you are not doing Roth IRAs because you're hearing these myths from other accountants or advisors that just simply aren't true. So we're going to dive into that. And Joe, I got to say, you and I, over the years, have said this over and over, that the Roth IRA is one of the best gifts the IRS has given us in decades.
Well, if you think about it, tax-free, right? If I save money, I accumulate money, and I don't have to pay any dollars in tax ever again on those, I don't know what else is better. But we've been taught for years and years and years to put as much money into your normal retirement plan, such as your 401k pre-tax, get the tax deduction today, have it grow tax deferred, and then when you pull it out, then you'll pay the tax. But wait, you're retired, so you'll be in a lot lower tax bracket. Well, that's not the case for a lot of you. If you've saved some money, if you want to maintain your same lifestyle, and if most of your assets are sitting in your retirement accounts, you might see that you're stuck in the same tax bracket that you are right now, or potentially even a higher tax bracket depending on other income sources. Because let's realize it, Al and I have been doing this for a very long time, and most of our viewers have this, a huge amount of money in a retirement account, they have a house, and then they have a Toyota, right? They have very little other assets because everything is jammed up in this retirement account, and it's a tax time bomb that we have to at least diffuse some of this thing.
Yeah, I totally agree. So let's get into what a Roth IRA is. And as I mentioned, it was 1997 that this came about. And it's a special kind of retirement account. And a lot of people ask us, what does a Roth earn? What kind of investment rate of return? And really, that's not really the right kind of question to ask. It's really more that you can do stocks and bonds, mutual funds, and real estate inside your Roth IRA just like a regular IRA. But getting to what it is, it's a special type of retirement account where there's no current tax deduction. And get this, tax-free income, growth, and principal forever.
For life.
For life. And that means if you pass away, that your spouse gets it tax-free. If both of you pass away, the kids get it tax-free forever. And forever is a long time when you're talking tax-free income.
Yeah, but then the argument is, well, you're foregoing a tax deduction today.
Sure.
Well, think about it, right? If you're putting in a couple $100s a month, or maybe a couple $1,000s a year, or maybe a couple $1,000s a month in your retirement account, yes, you are getting a tax deduction for that. So you save a couple of $1,000s in taxes. But all of that money grows in that account, right, tax deferred, but then every single dollar that comes out of there is taxed at ordinary income rates. We're not saying ignore it, but you want to make sure that you have some diversification. And if you don't have a Roth or Roth 401k or something like that, I think you're missing the boat.
Yeah, absolutely. And talking about what the investments can be, as I mentioned before, you can invest in basically anything the same as an IRA, 401k, stocks and bonds, mutual funds, ETFs, index funds, even real estate if you get a self-directed Roth IRA. So realize this, that a Roth IRA is nothing more than a retirement shell, if you will. In other words, you can invest in anything that you could otherwise invest in an IRA in a regular Roth.
Right. It's just a shell that you can open at a bank, at a brokerage account, at a mutual fund company, anything that you want. Anything but collectibles and life insurance.
Correct.
So, like you said before, Al, most people think, well, what rate of return does a Roth have? Well, it depends on what investment that you fund the Roth. So if you really enjoy some investments in your 401k and your retirement account, well, you can have those same exact investments inside your Roth. Now, if we look at, well, who can contribute to this? I thought only special people, or I can't contribute to it. It may or may not be the case.
Yeah, and you have to have a job, you have to be self-employed. So you have to have earned income, or your spouse has to have earned income. And get this, there's no age restrictions. So I don't really care if you're 18 years old or you're 100 years old. You can contribute to a Roth IRA as long as you or your spouse have earned income. But Joe, there are income limitations at certain levels, and it's where when you're single, and in 2015, it's $116,000 to where you cannot, you can no longer contribute. But before we go into that, let's talk about what the contribution limits are. It's $5,500 per person. And $6,500 if you're 50 and older. And then a Roth 401k, a lot of you guys have Roth provisions inside your 401k that allow you to put money into a Roth. It's $18,000 there, $24,000 if you're 50 and older. And so in many cases, you can actually do both. You can do a Roth contribution and a Roth 401k. You can get quite a bit of money into the Roth just from those two methods, Joe.
Yeah, I would say this. If you look at your employer, all right, so talk to HR, because more and more employers are having the Roth provision inside your 401k plan. A lot of you have it and don't even know that you can contribute to it. It's an after-tax contribution. It will grow 100% tax-free for the rest of your life. There is no income limitations on a Roth 401k. However, there is income limitations on a Roth IRA. So we'll get into that a little bit more detail when we get back from the break. I also want to get in and dive in a little bit more about how to get more money in there. There's something that's called a Roth IRA conversion. So we talked about contributions, conversions, the Roth. What the heck is all this stuff, and why would I even want to do it? Stick around, because we're going to put it together, because when you start taking distributions, if you start taking retirement income from your portfolio, you want to make sure that you have some diversity, that you have areas where you can pull from that's not going to be taxed at all. Because when are you the most vulnerable? It's when you're retired, and if you have a pool of money that you can draw from and not pay any tax, you'll be so happy that you have it. Don't go anywhere. The show's called Your Money, and it's Your Wealth. We're just getting started.
Not sure if your retirement strategy is adding up? Sit down with one of Pure Financial's advisors for a free financial assessment to see if your goals are in reach. We can show you how Just go to our website at yourmoneyyourwealth.com or call 888-99-GOALS. That's 888-99-GOALS. Pure Financial Advisors, trustworthy by design.
Hey, welcome back to the show. The show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine hanging out. Thanks for tuning in. Hey, we're talking about tax-efficient investing when it comes to your overall retirement. And taxes is one of the biggest expenses a lot of you are going to have to pay in retirement. And we're looking at some ways to figure out how do you create the most income with the least amount of tax. I think most people want to learn how to do that. It just takes a little bit of strategy. So stick around and we'll tell you some strategy that you might not be aware of. Before we dive in, let's go into the true false. Let's test your knowledge.
If I have a 401k with pre-tax and post-tax dollars, I can roll the pre-tax dollars to a regular IRA and the post-tax dollars to a Roth IRA. And the answer to that question is absolutely true. And Joe, this is new. This is last September. The IRS just came out with pronouncements that if you have a 401k, you can take that pre-tax part, and put that into your regular IRA and the post-tax, which means that's money that you have in the 401k that you don't have a tax deduction. You could put that in directly in a Roth IRA. And Joe, remember even just a few months ago,
right,
a year ago, there was all these strategies. Well, you know what, if you do this and this and this and this and this and this, maybe it'll work, but no one wanted to do it because it would probably been disallowed by the IRS.
Yeah, right, it was really cloudy. So now this is really important for all of you, is that if you do have post-tax dollars, that after-tax dollars that you have in a 401k plan, before a lot of you made it just take it as a distribution, it was tax-free, but now you can put it directly into a Roth IRA. It's a huge, huge deal because all of that money will grow 100% tax-free for you. Speaking of Roth IRAs, we talked about contributions in the last segment. A few different things that you want to make sure that you are aware of on a contribution is that there's income limitations. I'm going to come to the conversion in just 2 seconds, but I think it's a lot of you might not be able to go directly as a contribution because they make too much money, Al.
Yeah, that's right. And the contribution limits, at least for 2015, if you're single, you have to make less than $116,000, and if you're married, it's less than $183,000. And there are phase-out periods, so you can make a little bit more than that. You can get a partial contribution. But realize that we have those limits. And for those of you watching this show before April 15th, 2015, you can still do a Roth contribution for 2014. So be aware of that if you qualify.
Now, let's look at, some different ways that I don't care how much money that you make, you can still put money into a Roth IRA, and that's with a conversion. It's something completely different. So what is a Roth IRA conversion? It's taking money from your existing retirement account and moving it into a Roth IRA.
Yeah, and all future growth in income is tax-free. But here's the caveat, you must pay taxes on the conversion amount. So you don't just want to convert any amount. In fact, here's the thing, is you can convert any amount you want to. You got $1 million in an IRA or 401k, you can convert the whole thing, but you probably shouldn't because the tax bracket will simply be too high. But we get this question all the time is, well, wait a minute, I don't really qualify for a conversion. And the answer is that's not true. Everybody qualifies. Starting in 2010, they took the income limitation away. So before that, you had to make less than $100,000 to do a conversion. But now anybody can do a conversion, any age, any income level, working or retired. Remember when I talked contributions, I said you had to be working. When you do a conversion, you don't have to be working. You can be 85 years old, retired for the last 20 years, you can still do a conversion. And Joe, this is a way to get a lot of money into a Roth IRA because there is no limit as to how much you do.
Right, let's break it down real simply. All right, so when you look, let's go back here because this is where a lot of people's money's at. This is just your standard 401k. So you put the dollars in, you get the tax deduction, it grows tax deferred. The bad thing is that when you start taking distributions, right, you need to create a retirement income strategy at some point. You want to live. You pull the money from the retirement account, you're taxed at the highest of rates, ordinary income. So this is a really nice pool up here. This is all tax-free. So any dollar that goes in grows 100% tax-free. You put $5,000 in, it grows to $10,000. You pull it out, guess what? Zero tax. We looked at contribution. So that's taking taxable money that you have in your savings checking accounts, contributing it directly into a Roth. That's $5,500. But now let's jumpstart that. Let's get a little bit more aggressive, if you will, and start bleeding some of the money out that you have down here, and you can now move directly those dollars into a Roth. It's a huge, huge deal. The bad thing is, of course, you have to pay the tax on it. So let's go into the tax brackets, Al. Let's see what makes sense, what doesn't make sense for individuals, because I'll break it all down for you why it makes so much sense, but there's a lot of myths. So you want to make sure that you look at your tax bracket to see how much is appropriate for you.
Yeah, Joe, a lot of times when we have this chat with clients and people that are interested, they'll say, well, okay, that's a great idea. I'm going to convert $50,000 or $100,000 or $200,000 or $2,000, whatever the number is. And that's okay, you're on the right track, but there's a little bit smarter way to do this. And the way that you figure this out is you got to take a look at your tax bracket. You got to go to line 43 of your tax return to figure out what your taxable income is. And then you look at the tax tables. And there are single tables, there are married filing joint tables. They start at 10%, they go to 15%, 25%, and so on. So you have to take a look at what bracket you're in currently, what bracket you may be in retirement to figure out how much conversion. And here's a quick little example. Here's a table of a married filing joint table. Look at this, 0 to $18,450 is taxed at 10%. Any dollars above that, $18,451 to $74,900 is taxed at 15%. And then once you get over that, the next dollars are taxed at 25%. If you're in the 25% bracket now and will always be in the 25% bracket, then convert to the top of that bracket. If your income, taxable income is $100,000, you can do about a $50,000 conversion and stay in that bracket.
Right. I mean, this is really important to take a look at. So when you look at these brackets, right, so here's the 15%, 10 or 25 and so on and so forth. So you look at your tax return, you say, well, what tax bracket am I in? Right? Let's say that your taxable income is $50,000, all right? So I'm married, I look, $50,000 is my taxable income. Then I'll look at this table and say, well, the top of the 15 is about $75,000. So maybe then I should take $25,000 from this account and move it up into the tax-free. Yes, you will pay 15% tax federally on that conversion, but guess what? There is no way around the tax in these accounts. You will pay it, your spouse will pay it, the kids will pay it. There is no way around it, right? You're stuck and it's infested with taxes here. What we're suggesting is that you start slowly bleeding some of these dollars out to get money up here, because then when you pull it out, it is tax-free. Let me illustrate the concept, because this is how tax brackets work. They stair step. Okay, they go up. I'm just going to illustrate, let's say a 10%, 15%, 25%, 28%, and then it will continue to go up and up and up and up. What I'm looking at is this, is that a lot of people end up here in these higher tax brackets because all of your income is taxed at ordinary income rates. You got Social Security, pension, real estate income, 401k, interest from CDs, whatever it is. It's all taxed at the highest of rates. So when I'm looking at a strategy, if all of my money is sitting here, I'm stuck, right? I'm stuck with the tax of how much money that I pull out. But now look at this. If I have money up here, that is tax-free. And I have money down here that's tax deferred. So when I start taking my distributions, I'm going to pull a little bit from this account and a little bit from this account. Now watch. So I'm going to keep myself down in these lower brackets because I'm only pulling enough from that 401k plan, and I'm going to stop here at the 15. But I want more income, right? I want to go on more trips. I want to spoil the grandkids. So I need more cash. So I'm going to pull it from the Roth. So I'm living up here in these higher brackets, right? But I'm only paying down here. That is the concept. That is the key. Because what we find is that more and more people just have these huge amounts of money in their 401k plans, IRAs, 403bs. They have very little diversification, and you have no control over your taxes in retirement. This will be one of the biggest expenses in your retirement is taxes. There's ways to control it. There's ways to diffuse this if you do a little bit of planning. All right, we got to take another break. Don't go anywhere. When we get back, there's a lot of myths. You're probably going to Google this. Hey, should I do a Roth IRA, Roth conversion? Should I do it? Should I not? I don't know. Should I listen to these guys? The answer is yes, do it. But we'll dispel some of the myths when we get right back from the break. Show's called Your Money, Your Wealth. Do not go anywhere. Hey, welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine hanging out today talking about tax efficiencies when it comes to your retirement income and some planning that you might want to take a look at to be better off long term. Let's go to the true false and see how you did here.
when I turn 70 and a half, I can give my retirement minimum distribution directly to charity and avoid paying tax on it. Easy for me to say.
Yeah, that's very easy for you to say. That just that rolled right off your tongue.
That was different than what was on my paper. That's why I got screwed up.
Yes and no. You got to take a look. That was the law. Well, they might change the law. So before you could go up to about close to $100,000, your required minimum distribution. That's what you have to take from your retirement account and go directly to a charity. That is not the law today, but it probably will go back to that. What do you think, Big Al?
Yeah, I would think so too, because the last couple of years they've had that law. It expired and then they renewed it. So they probably will again here in 2015, but we don't have it just yet.
Hey, we're talking Roth IRAs, Roth conversions, Roth contributions, getting a little bit more diversity in your retirement income strategy by having different money in different areas where they're taxed differently. Let's go to some myths, because a lot of you might have looked at this and said, hey, maybe this doesn't make sense for me. One of the myths is that, hey, you know what, I can only put $5,500 into a Roth IRA. That's absolutely false, because you can do conversions. For anyone that has a retirement account outside of a Roth IRA, you could do a conversion. So you could take money from that retirement account and convert it. Now there's different rules and regulations. So if you just have a 401k plan and you're still an active participant in that plan, you may or may not, you could look for an in-service withdrawal, in-service distribution or something like that to do it. If there's a Roth provision in the plan, you can go into the Roth. So there's a lot of different rules and regs, but for the most part, you could put more money into the Roth, more than $5,500 now. And
yeah,
then plus there's a catch-up too of $1,000.
Yeah, that's what I was going to say. If you're over 50, you can put $6,500, and if you have a 401k, you can put $18,000 into the Roth 401k component, and if you're 50 and older, it's $24,000. And as you mentioned, Joe, Roth conversion unlimited. Now, the other myth that people they have problems with is they think they can't touch their money for 5 years, and that's not true. They can actually touch their principal on a conversion as long as they're 59 and a half and older. They can touch their money on contributions immediately. They just can't get at the growth. Now here's a couple more things. Roth conversions only make sense for the young, and it takes 10 years to break even. Well, this is completely a myth, Joe, because you're not really thinking about this correctly. When you pay the tax on your IRA, you would have paid the tax on the IRA anyway when you retire. So it's same. In other words, the purchasing power of your IRA versus the net of the Roth, which is already paid tax, they're the same. And what I mean by that, $100,000 IRA, if you're in a 25% tax bracket, when you withdraw the money, you only get to keep $75,000. Well, if you do that same money, convert it to a Roth, pay $25,000 tax, you still have the $75,000. So it's same. So it actually can make sense at any age to do conversions.
Right, and you break even day one in some cases, and then, but we're not worried about day one. We're looking at year 2, 5, 10, because now all future growth grows tax-free. Let's flip the show over back to you, our viewers, and let's go to a couple of email questions before we get out of here.
All right. My 401k has a Roth provision. Should I make contributions to my regular 401k or the Roth 401k?
What's that name? Is that Julie in Solana
Julie.
Beach?
Yeah, that's Julie from
Solana Beach.
Solana Beach, yeah.
Hey, well, it depends. Julie, you have to take a look at what tax bracket that you're in is going to make the most sense. So if you're in a very high tax bracket, probably putting it into the standard 401k is going to be better off. If you're in a lower tax bracket, 15%, 25%, something like that, you might want to consider the Roth. Here's another thing, is that if you have zero Roth dollars, let's say you never opened up a Roth IRA, you have zero money in a tax-free account or tax-free pool, it still might make sense to take a look at it to get some more diversity when you start taking retirement distributions long term. Let's go to another one real quick.
Okay. Number 2, this is from Greg in Pacific Beach. Shouldn't I wait until I'm 60 to do my Roth conversions to avoid the 10% early withdrawal penalty? And Greg, you're probably thinking 59 and a half, because that's when the 10% penalty goes away. But when you do Roth conversions, there is no 10% penalty. So you can do conversions at any age. I don't care if you're 20, 30, 40, 50. You can still do those conversions without the 10% penalty. Yeah,
I mean, that's probably one of the biggest misconceptions, is that people think as soon as you start taking money out of your IRA and putting it into a Roth IRA, you have to wait until you're 59 and a half. That is just not true. If you're 20 years old, 30 years old, 40 years old, 50-year-old, you could put money into a Roth from a conversion, and you probably want to take a look at it. The IRS classifies it as a rollover. You do have to pay tax. Here's where the 10% penalty applies. Let's say I convert $10,000 from my retirement account into a Roth IRA. I do it tomorrow. Next year, when I do my taxes, and let's say I owe another $1,000 of tax, I go back to the IRA, pull money out of the IRA to pay the additional tax, that $1,000 would be subject to a 10% penalty. That would not apply. Also, if I do a Roth IRA conversion, if I'm under 59 and a half, and if I withheld taxes, don't do that, because those withholdings would also be subject to a 10% penalty. Do a direct conversion, you're going to be safe, you will pay taxes, but you will not pay that 10% penalty. A lot of different myths out there. There's a lot of different rules and regulations that you want to make sure that you consider. So that's why you got to watch this show each and every week. Thanks for joining us today. For Big Al Clothesline, I'm Joe Anderson. Have a wonderful weekend. You just watched Your Money, Your Wealth.